Hello, everyone. This is Steve Gorin, and thank you for attending today's webinar, Business Charitable Deductions, Business Entity or Trust, Basis Step-Up and Powers of Appointment. Before we begin, I wanted to cover a few housekeeping items. If you have any questions during the webcast, you can submit them during the Q&A widget. We will try to answer these during the webcast, but if a more complete answer is needed or run out of time, I can answer it later via email, and you're certainly welcome to just directly email me with your questions. A copy of today's slide deck, as well as the most recent version of my current business succession materials, are available in the resource widget. We encourage you to download any resources or links that you may find useful. You can find additional answers to some common technical questions located in the help widget. If you experience any technical problems during the webinar, these can also be reported through the Q&A widget. Today's presentation is CLE accredited in California, Illinois, and Texas for 1.5 hours of general credit, in Missouri for 1.8 hours of general credit, and in New York for 1.5 hours of professional practice credit for experienced and transitional attorneys. We award CLE based on attendance for the entire 90 minutes. As we required, we will display secret words in 3 multiple choice polls during the presentation. You'll be required to select today's secret words from a multiple choice list. Please respond to those polls to demonstrate your continued engagement and to earn your full CLE credit. Now for CPAs, we do not offer CPE credit. If you would like to get CPE credit, then you could attend my CPA Academy webinar on November 17th. You can go into my CPA Academy instructor page, which is linked, I think, on the last slide, but definitely in my newsletter. And that's, again, a 2-hour webinar to get 2 CPE hours. And there's another one after November 11th if you want to get the other version. So we value your opinions and appreciate your participation in the course. All right, on to a little bit more. So we have an overview. We'll talk about business charitable deductions and talk about, a little bit about the 237th limitation. Then we'll talk about the 237th limitation, by the way, which is from the July 4th new tax law. And then we'll talk about just a little bit of overview of business entity or trust, because we had some recent case on the topic of whether a trust was a business entity or not. But we'll also add some stuff in about electing out of partnership reporting and other things like that. And then we'll talk about basis step-up and powers of appointment. Okay, so I already mentioned the materials. And so if you click on the newsletter that's attached, there's newsletter articles that link to the page on the big PDF supporting the article. And of course, there's the widget that has my business structure materials. And there's some, if you download both the slides and the big PDF, here's some ideas on how you can kind of navigate between them. And going to that full table of contents is better than doing the search function. The search function kind of slows you down on the PDF, whereas doing going to the full table of contents will help get you there faster in general. Okay, so we'll talk about how businesses can try to get full charitable deductions after the July 4th, 2025 tax changes. So that the formal name of that law is HR 1, which is basically a bill to reconcile the budget. It was originally enacted and introduced as the One Big Beautiful Bill Act, but that was struck by the Senate parliamentarian, just like the Senate parliamentarian also took out the name Tax Cuts and Jobs Act. But that doesn't prevent people from using those terms. So you'll see I may have some references to OBBBA here. We have lots of different names for OBBA. I've heard somebody call it ABBA, and for that I say Mamma Mia. We have people call it OB3 because they like Star Wars, and then if you don't like the law, then we can call it the Big Ugly Bill Act, or BUBBA. So all kinds of ways to reference the new law. I'll just probably say the new law. So we're going to talk about how a business can structure a donation to charity as a business expense, and instead of subjecting it to the charitable deduction limitations. And then we'll also talk a little bit about charitable deductions by trust and owned business entity, passive entities. Okay, so deductions for charitable contributions made by C Corps are limited to 10% of their taxable income, which is old law, but are reduced by 1% of their taxable income, which is new law. And of course, if you have an S Corp or partnership, including an LLC, those are going to be deducted at the owner level, subject to various limitations. So you'd wind up having the Code Section 170 limitation for that, generally. So what if you have an individual or a trust on the K1 from the partnerships or S corporations? So we've got the basis limitation, and we also have percentage of modified adjusted gross income limitations if the taxpayer is an individual. And as we'll discuss in a little bit, also if the trust has unrelated business taxable income, then these limitations also apply. And then there's the 237th reduction of itemized deductions that applies. And now I put in there individuals only, but actually it also applies to trusts. And that's because a trust is taxed as an individual, except as otherwise provided in the tax laws. So the 237th reduction does apply to trusts. So how can we convert this into a charitable deduction into a business expense so we can avoid these limitations? So I have here the regulation, the basic regulation for whether something is for the use of an entity described in 170C. So notice that doesn't say that we're applying 170C for the deduction. That just says that we are describing an entity that's described in 170C. And so it says here that if you have a payment to a charity that bears where the payment bears direct relationship to the taxpayer's business and is made with reasonable expectation of some kind of financial benefit that is commensurate with the amount of the payment, then that may be a business expense rather than a charitable deductions. And then if it's not deductible as a business expense, then you can go back and look at the charitable deduction. So they give an example. An individual is a sole proprietor who makes musical instruments and sells them through a web page. A makes a $1,000 payment to a local church for a half-page advertisement in the church's program for a concert. So in the program, the church thanks its concert supporters, including A, and A's ad includes the URL for the website through which A sells its instruments. So you can click on the ad and get over to the selling point. And A thinks that the ad will attract new customers to A's website and help A get more musical instruments sold. So A can treat the $1,000 payment as an expense of carrying on the business. Now, Although A is helpful, you need to distinguish between a mere public acknowledgement, which is a 170 deduction, and advertising, which is the Code Section 162 deduction. Also, if a charity goes too far, I mean, if it is an advertisement, then query whether the charity has unrelated business taxable income and is going to pay a tax on that advertising. So that using example one can be a little bit problematic. Now, let's look at example two. So P, a partnership, operates a chain of supermarkets and operates a promotional program in which it sets aside the proceeds from 1% of its sales for the year and pays those to charities. The funds are earmarked for use in projects that improve the conditions in the state in which it's doing its sales. And the partnership makes the final determination on which charities receive payment. The partnership advertises the program and believes it's going to get good bang for the buck in terms of getting sales relative to the payment, these payments to the various charities. And then, as part of the program, it pays $1,000 to a charity, and the partnership may treat the $1,000 payment as an expense of carrying on a business. And they threw in some more stuff about state tax credits. I'm not going to get into all the details on state tax credits and how that works with business expenses. Example two is very attractive. And think about, rather than a percentage of sales annually, the business might do more time-limited promotion to see how much is raised. So you can want to titrate your contribution. And, businesses commonly run, what they'll call things a sale. So the time-limited promotion doesn't really seem to be unusual to me. And restaurants are a great case study for this. They will engage in promotions similar to that example. Like they'll say 10% of all sales on Tuesdays will be donated to a particular charity. Since Tuesdays are slow, they really want to drive the business on Tuesdays. So this really helps them out, and the charity would publicize a promotion. Now, think about whether the business entity might want to start a charity or perhaps a social welfare organization that might bear its name, which many businesses have done. Like in St. Louis, we have the St. Louis Cardinals, and we have Cardinals Care, which is their affiliated charity. And of course, Cardinals Care wants people all over to donate to the charity, but the Cardinals get the publicity from what Cardinals Care does. I discussed this idea on a committee call within the ABA Real Property Trust and State Law section, Charitable Organizations Committee, and one of the people on the call who is very well respected for her expertise in this area said that you would need to consider whether self-dealing prohibitions may apply within that affiliated organization. So I guess don't have that affiliated organization promote too closely what's going on with the taxable organization. If you're bearing the name, that might be sufficient tie-in where instead of having more active things where the affiliated organization actually says, go and buy things from my main sponsor. Now, if the business entity merely accrues the obligation to pay the charity, that deduction might be deferred. So we don't want to just do a reserve. We want to get an actual payment during the year or maybe immediately after the end of the year. Okay, today's first secret word is pumpkin. So please select the correct word below. Spiced pumpkin or latte, of course, that's going to be pumpkin. Basis of any appreciated assets. And then the 237th itemizes allowance deduction under Code Section 68 for individuals may apply to trust and estate charitable deductions. So this is pretty controversial. The case law tends to favor this applying to that without limitation language in 642C, applying that to the percentage limitations under Code Section 170. So the idea is when 642C1 and 2 say that the deduction is allowed without limitation, that refers to the Code Section 170C. Code Section 170, like whatever the subsections, percentage limitations, the 10% for charitable contributions from corporations, and then the 20 to 60% for individuals. Some people are saying that the 237th limitation, it has a scope beyond that. Dan Guestbast, who was high up in the IRS before he jumped ship after the Doge antics occurred, wrote an article saying that he thinks without limitation might apply. So I'm going to push out into the chat here another case called Green. Let's see here. Okay. Sorry, it's taking me a minute. I'm not all that competent with this particular way of pushing it out. And okay, and hopefully that appears for everybody. David, you could just answer me in the chat really quickly to make sure I did it right. So the Green case was a contribution to charity of appreciated stock, and Code Section 642C says that the contribution has to come out of gross income, and the court says that they would determine this basis. Basically, has it out of gross income? There's no tracing requirement for the out of gross income requirement in 642C, but it needs to be feasible. The gross income might at one time have generated whatever gets contributed to charity. So, like if you had stock that was worth 50, but you had a basis of 10, how much gross income could possibly have gone into that stock? Well, assuming that the trust bought the stock sometime after it was funded, rather than that being a gifted asset. So if the trust bought that stock, then the maximum amount of gross income that could have been used to buy that stock would have been $10, because that was the basis. So the Green case, which was a 10th Circuit case, held that the contribution was limited to basis. And then the trust said, hey, there's this without limitation argument. And the court said, no, that without limitation argument was basically intended only to make clear that the percentage limits in Code Section 170 do not apply to charitable deductions made, estates, and trusts. So that was the statement it made. But, the question is, to me, 6482C does have the out of gross income language. So, I'm not quite sure whether the court, that was just kind of dictum from the court in the Green case, and the Benedict case that it cited is, I don't know, I think there might be more than one reading possibly. So one of my partners says he doesn't think that there's even a reasonable basis for taking the position that the without limitation language in 642C 1 and 2 would allow you to get around the Code Section 68 limitation of the 237th limitation. I think that there's a lot of other people who disagree with that. I would say that in light of the Green case, I wouldn't take a substantial authority reporting position. So for those who want to take the deduction because they're persuaded by guest pass's argument about without limitation and arguments other people made about it, then I would say that you would want to take a reasonable basis argument, which is generally about a 10 or 20% chance of winning, and then attach Form 8275 to your return to try to avoid penalties. So that's an approach that you might consider taking. And now you have the citation to Green, so you have full information. I do have Green in my outline about talking about the fair market value versus basis issue, but I didn't have it in my outline when it came to the 237th limitation. So I'll eventually put it in for next quarter, but at least you have it in your Q&A widget, and so now you've got it available. Okay, now for trust and estates, if you have unrelated, I'm sorry, not trust and estates, just for trusts. So for trusts, if you have unrelated business income, then you don't get a 642C deduction of 100% of gross income. Rather, you apply the individual percentage limitations. Now, if your K1 is coming from a partnership, then it's unrelated business income only to the extent that the income fits within the usual unrelated business income categories. And you can see there that cross-reference to 2Q6D, where I explain what unrelated business income is. Now, S corporation K1 income is automatically unrelated business income no matter the source. So for example, interest income is not unrelated business income. But if you have interest income on an S Corp K1, it is unrelated business income because of this override for the S Corporation K1s. So if you are reverting to the individual limitations because of the unrelated business income, there's advantage and disadvantage. An advantage is that then if you're in Code Section 170, then you could deduct the full fair market value instead of just basis. So that's a great benefit when you're making a donation to public charity. The disadvantage is that you've got the various cutbacks that apply to individual charitable contributions, such as the limitations of 20 to 60% and the 0.5% reduction by adjusted gross income. So if a trust has substantially appreciated securities, which would make the charitable contribution more desirable, the trust could consider forming an S corporation and making an ESPT election. That does involve various complexities, which I will probably address in next quarter's newsletter and webinar. All right, on to the second topic, business entity or trust. A trust can sometimes be taxed as a business entity. A trust can be a holding company under banking law, and I'm going to talk about the effect of opting out of annual partnership income tax reporting. And by the way, I still encourage you to put your questions in the chat, and I'll answer them the next time we do a polling question, or if I get to another good stopping point. Okay, so what's the difference between a trust and a business entity? So here we are on slide 26, and generally a trust has trustees that take title for the purpose of protecting or conserving the property for beneficiaries under the ordinary rules that are applied in the courts that govern trust administration. Usually the beneficiaries of such a trust do no more than accept the benefits, and they're not the grantors of the trust. They are simply the passive recipients. Okay. The other part is that the beneficiaries may be the persons who create it, because, for example, you have a revocable trust, and the revocable trust is going to be a trust. So that still is okay. But in a revocable trust, you typically just have a single individual or perhaps a married couple, and those people will do the trust just for estate planning purposes. They're not really trying to form a business. And here we go. To me, what I think the crux of it is that a trust, an arrangement is a trust if it can be shown that the purpose of the arrangement is to vest in trustees' responsibility for protection and conservation of property for the beneficiaries, and the beneficiaries don't share in the discharge of responsibility, and therefore they're not associates in the joint enterprise for the conduct of business for profit. Now, a beneficiary can be a trustee. There's no problem at all about that. But the key is that the grantor created the trust and the beneficiary didn't put the money into it. So when we're talking about a non-grantor trust, that's the deal. So the real penultimate case for business entity versus trust is the estate of Bedell versus Commissioner, which was a reviewed case. And the trust ran real estate businesses and provided mandatory income interest as separate shares for the descendants. And the tax court held that the trust may be recharacterized only if it includes associates and an objective to carry on business and divide the gains from it. Bedell held, we conclude that the beneficiaries who neither created nor contributed to the trust, whose interests in the trust are not transferable, and only a few of whom participate in the trust affairs are not associates, and their trust is not an association. So again, that was key, that the beneficiaries they were not the nominal grantor, so they didn't create the trust. They were not the gratuitous grantor who actually put the money into the trust. The regulations, code section, regulation 1.67D1-2 parentheses E goes into this idea that you need to put money into a trust in order to be the deemed owner to get things attributed to you for tax purposes. There is some language in 1.672-1E that talks about the idea that you can be, if you merely sign a document, you can be a grantor, but that's only for purposes of, there's some foreign trust reporting rules that say if you're a grantor, you have to do these foreign trust reporting. That's only if it's only the nominal grantor, that's when they have to do the reporting. So other than the foreign trust reporting, it goes by what portion of the trust did each person contribute. There's some lawyers in, I think, the state of Washington who take the position that if you have a joint trust, then you can be the deemed owner of it, even if the surviving spouse could be the deemed owner, even if the surviving spouse contributed only half of the trust. And they're just dead wrong. And they're risking malpractice when they tell people that you can take a post-mortem trust and it can qualify as an S shareholder as a wholly owned grantor trust. The one exception to my comment on that is if the deceased spouse's share was in a fully revocable trust after death and the surviving spouse can revoke the entire trust, then the surviving spouse is the deemed owner of one half that they put in, under 676, and they're the deemed owner of the half that the decedent put in under 678A1, which is a right to withdraw. So they're not the deemed owner as the grantor for that half, but they are the deemed owner as a beneficiary simply because of 678A1. But if they didn't have a withdrawal power under 678A1, they wouldn't be the deemed owner of that half, and the trust would not qualify. So I digress a little bit, but I was talking about multiple beneficiary trusts and multiple grantor trusts. So there we go. So in that case, the government said, look, if the trust engages in an act of business, then the trust is a business entity. And the court said, no. On that prior slide, it said, no, the beneficiaries didn't have anything to do with creating the trust, and they didn't put any money into the trust. So no, just because the trust runs a business, that does not make the trust a business entity. And the tax court went on to say, it is difficult to imagine a more unsuitable vehicle than this case for any such purpose. And it's regrettable that extended misguided efforts were exerted, so the IRS was wasting its money to such a fruitless end in this litigation. Now, we have a couple of relatively recent cases that involve foreign entities, and the question is how they were classified, and the answer was that they functioned as they functioned as trusts, so they called them trusts. They tax in the trust. And then that second case, the 2023 case, the Fairbank case, said that we have four elements of the trust for federal tax purposes: a grantor, a trustee that takes title to protect or conserve it, property, and designated beneficiaries. And they said that it's widely accepted under the laws of all the states that a trust consists of those four elements. And they basically say that that the arrangement that was there closely resembles a typical trust, where the settlor establishes a trust for the benefit of beneficiaries, contributes property, and designates a trustee to hold the property and act in their best interest. So a little bit more recent rules on it. So today's second secret word is trick. Please select the correct word below. Okay, again, trick is the correct word. Give you another moment to respond. We have 64%. If we can push it over 70. All right. All right, so we have 71% responded. 76. All right, we're good to go. Okay. Now let's contrast that to the regulation for business trusts. And the regulation says that we have something that are called business trusts because legal title property is conveyed to the trustee for the benefit of beneficiaries, but they are not classified as trusts under the tax law because they are not simply arrangements to protect or conserve the property for the beneficiaries. So business trusts are simply a device to carry on a profit-making business, which would have been carried on through business organizations that are classified as corporations or partnerships. And the fact that the beneficiaries don't supply the corpus is not sufficient reason in and of itself for making it be an ordinary trust. The fact that it's technically cast in trust form will not change the real character if the organization is more properly classified as a business entity. So we have a bunch of case law on it, and where I was in 2D1, that goes through a bunch of case law, harkening back to Supreme Court cases. Now let's talk for a moment about multiple owner trusts that are disregarded for income tax purposes. We'll talk about unit investment trusts, where the trustee role is relatively passive. We'll talk about liquidating trusts. Well, I'm not going to really talk about, there's liquidating trusts, environmental remediation trusts, and those I'm not going to talk about. Those are things that my corporate partners tend to deal with, and I don't really specialize in those. But unit investment trusts are important to know about, and we'll see a common use in a moment. So the most common use in estate planning for a unit investment trust is a voting trust. So you have the owners of stock would like to control the governance. They want to control how the stock is voted. They want to vest that right in particular people, the voting trustees. So the owners of the stock contribute their stock to the voting trust. And in exchange, the holders receive back voting trust certificates. Now, you don't really have to have a certificate for that, but you need to have the beneficial rights there. And And so the owners of these voting trust certificates are deemed to hold the stock that the voting trust holds. And so if they go and transfer the voting trust certificate, that's just like the sale of the stock. Now, the voting trustee, their sole role is to vote the stock of the company. Whenever any money comes in to the voting trust, the voting trustee is required to immediately distribute it to the voting trust certificate holders, unless they need to use, the voting trustee needs to use it for administrative expenses, like paying the voting trustee, or perhaps doing a Form 1041 with a grantor information statement. So in the voting trust, the beneficiaries are the ones who are contributing to the trust. So it is a multi-grantor trust, which at first blush might disqualify it, because it looks like, they're putting their stock in, they're pooling their stock to generate profits because they want to get the returns from the stock. And the true key to the unit investment trust is that the trustee is not allowed to do anything with the money other than pay trust administrative expenses and distribute it to the beneficiaries. So the trustee can't say, all right, I've got a distribution from the corporation and I want to reinvest it because I think I can invest it better than the beneficiaries can. No, they are not allowed to do that. From a financial viewpoint, the trustee is just a mere conduit. Everything the trustee does is ministerial when it comes to the trust assets, other than voting the stock, which is definitely not a ministerial thing. So voting the stock they can do, but everything that relates to whatever the trust receives in terms of property is purely ministerial. So another type, when I first was practicing accounting and I would do tax returns for people, we would get statements from municipal bonds trust or the insured municipal income trust. That was the common one too. And what that is that a syndicator will take a portfolio of municipal bonds, and sometimes they're diversified around the country, but sometimes they're just from within a particular state. Because even though the federal income tax return does not tax you generally on municipal bond income, except for AMT, which we're not going to get into, states will tax municipal bond income. And the only exception to that is the state will not tax municipal bonds from within that state, and it also won't tax certain federal government obligations. So a lot of times you would have these syndicators assemble a portfolio of municipal bonds from a particular state. But the bottom line is the syndicator will get this portfolio of bonds and then it'll go and sell that portfolio to the general public. And then when the syndicator is running the bond portfolio at that point, it is not trading in bonds. It is not selling the bonds before maturity. It's not trying to swap them for something else. It merely holds the bonds, and whenever any interest or principal comes through, comes to the trustee, then it sends those out to the beneficiaries. And the beneficiaries are the deemed owners. And then we would get notification from these unit investment trusts, the municipal bond trust, that here's your share of the tax-exempt income this year. Another unit investment trust is a Delaware statutory trust. Here, you have the syndicator who takes some real estate and leases it on a long-term lease to a master tenant. That master tenant then subleases the property. But the bottom line is that there's only one activity that the statutory trust is doing. Before the trust is syndicated, it enters into the master lease and is simply passively receiving the lease payments from the master tenant. And then the owners of the Delaware Statutory Trust will report the income from the trust. Again, there'll be statements that the syndicator will put out. And then they are deemed, since they're the deemed owners of this trust, they are deemed to hold the real estate. So you could take proceeds from the sale of your real estate and reinvest that in a Delaware statutory trust and qualify for Code Section 1031 like-kind exchange. So that's the point of it. A problem with the Delaware statutory trust is that there's no ready active market for them. At least I had a client who came into me a year or two ago and wanted to talk about how to manage it, maybe basis step-up issues, and because they had it inside their S corp, which was a very, very bad idea. But they didn't know better when they formed it. They were not my client when they formed it. They became my client after they created this mess. And they checked around. They did not feel confident that they could sell all of the Delaware statutory trust interest they had in their S corp all in the same year. So there's an S corp strategy where you sell everything in the same year and then liquidate, but they said they cannot do that. So they'll have to think of other arrangements other than that. So the lack of a ready market for this is a concern. Okay. What about if you have a tenant in common and the tenants in common own some real estate and they carry on rental real estate operations? I had this when I practiced accounting. We had a client in our building who owned a part of a shopping center, a strip mall that was next door. And they did get a bunch of investors into the strip mall, and each bought a tenant in common interest in the strip mall. And they took the position that the strip mall was not a partnership. I don't know how great that is, but we do have some issues in being able to elect out of partnership treatment for reporting purposes that we followed when we did that. So I'm going to go over that in a moment. But the issue is that if you are not formally an entity, but you're a tenant in common, and then you think about the Uniform Partnership Act. Uniform Partnership Act says that is a general partnership. So we have a problem with it being a general partnership because, so first of all, co-owners can require the other co-owners to buy them out. If one general partner wants out, they have a right to be bought out. The partnership agreement cannot prevent that buyout right. It can impose financial sanctions for exercising your buyout right, and those financial sanctions need to be related to the disruptiveness of that unexpected buyout occurring. Also, a general partnership has joint and several liability. Now, you can register as a limited liability partnership and get limited liability from that. But they would need to know to do that. If you have a limited partnership, the general partner is the one who has unlimited liability, and a limited partnership can elect to be a limited liability limited partnership, or triple LP, and that'll protect the general partner from liability. Unfortunately, my state of Missouri says if you don't timely renew your limited liability partnership filing, then you have exposure until you renew it, and you can't retroactively cure it. I think that Missouri might be the only state in the country that does that, where you can't retroactively cure it. But if anybody is in a state that has that provision as well, I ask you to email me so I can include it in my materials for next time. Okay, now, what if you have a tenant in common and there's certain regulatory requirements? And those tend to be that that whoever manages the property from year to year is not set in stone. That each year, any partner can, if any partner can opt out of that arrangement, if any tenant in common can opt out of that person managing it, the same person from year to year, that's the requirement to be able to opt out. And there's some other requirements as well. I set forth the regulations in my materials. Now, issuing multiple tenancy and common statements is not as easy as dealing with 1K1 from a practical viewpoint, because when you buy property, each item of property needs to have its basis divided among all the co-owners, and each co-owner on their tax return needs to separately account for the depreciation of every single item of property. So it's a lot easier to have a partnership that just adds all the property together and then just provides a K1. But if that's what you want, because of the tenants in common issue, then so be it. Now, the IRS longstanding position is that members of an LLC cannot opt out of partnership treatment. Now, there is one exception that I know of, which is under the Biden's Infrastructure Act. They provided some renewable energy credits and said that you can opt out of an LLC can opt out of partnership treatment. So, and then we have some 2024 regulations that implement that legislation. Now, otherwise, a married couple owning an LLC cannot opt out of partnership treatment unless they live in a community property state. There's a common misconception about that. Now, I would say probably about 10 years ago or so, I called the author of the revenue procedure that says that a married couple owning an LLC in a community property state can opt out. And I said, hey, I live in Missouri, which is not a community property state, but we have tenancy by the entirety. And the tenancy entirety ownership is much more tied up. It's much more of a unitary ownership than community property is. So would you consider issuing a revenue procedure that says the tenancy by the entirety property qualifies for the same opt-out. And the author said, no, that's not on our mind, and I doubt we will ever consider doing that. Here's what the revenue procedure was aimed at, according to this author. Suppose husband and wife are in a community property state, and wife starts an LLC, and wife puts money into the LLC, and it's titled in wife's name. And so it looks just like a regular disregarded entity. Well, under community property law, if the money that wife put in actually is community property, such as it could have been joint earnings or just earnings, earnings that either couple had, but there's a lot of ways it could be community property. If that cash that wife put in was community property, then husband is going to be a half owner of that LLC, even though nobody knows it. There wasn't any tracing done to determine that at this point. And from the viewpoint of the bank, they just see wife putting the money into the LLC. And from a third party, they just see wife as a sole member of the LLC. So they're going to make it a disregarded entity. So, and by the way, you find out about the tracing when the husband and wife go to get divorced, and then husband wants to share the business. So that's usually when you find out the tracing. But at any rate, and by the way, in California, I think, was it 3 out of 2 marriages and in divorce. So that's why you can do the opt-out. So the married couple needs to file jointly every year, and then they can report it on the appropriate disregarded entity form, Schedule C or Schedule E, typically. So the spouses, so somebody asks if you have spouses in a common law state and they create a joint revocable trust, then can you be a disregarded entity? And the answer is no, because it's not a community property state. So I've answered that question that's in the chat. All right. Now, a trust also may be treated as a holding company for the purposes of banking laws. I put these criteria in 2D8, and perpetual trusts generally are forbidden under that. So I have a client who did put his banking stock into a perpetual trust, and the client didn't, nobody knew about that regulation, but later on, it was when the client was asking about putting stock into another trust, then that regulation came up, and so now we're trying to figure out what can be done, and whether there's any way that they can get the banking regulators to approve of it. So more to be found out then, but it's not going to be anything officially announced. So sorry, I won't have any precedent to announce to you. Okay, penalty for failing to file a partnership return. So I got the penalties up there. So Rev Proc 84-35 says that failure to file penalty does not apply if you have 10 or fewer owners and each owner fully reports their share of the partnership's income deduction credits. Now, the Rev Proc does point in part to some partnership audit procedures that got changed with the BBA in 2015, I think it was. with a delayed effective date of like 2017 or 18, something like that. And so anyway, so some of what the RevProc refers to has been repealed, but there's a program manager technical advice where the IRS reaffirmed that the RevProc still applies, notwithstanding the BBA. So that's in my materials. So, and the IRS says this penalty is not an exemption for the retirement requirement to file, and if the partnership opts into the BBA, centralized partnership audit regime, then you don't get the relief. But going back to that second bullet point, so what if you have a married couple and they don't know that they're supposed to be filing a partnership return, and so they just skip it, then they just report it directly, just as if they had qualified for that RevProc on community property. Well, in that case, then chances are, since they reported everything, they're going to qualify for the relief under RevProc 8435. So, as an advisor, we would say that they do have to account for this as a partnership. If they're in a common law state, they have to count this as a partnership, and they should make partnership elections as needed. But they won't get penalized if they don't. But the problem is you may have some timely elections you need to make, and you're supposed to do those on a partnership return, and they don't make them on a partnership return, then query what the IRS will come back and do to them. So you may say no penalty, but I wouldn't say no big deal. So it really all depends on how they're running their LLC. All right. So as Forrest Gump says, that's all I have to say about that. Now let's get into the final topic, basis step up and powers of appointment. So I'm going to mainly focus on free basis step up, but before I do that, I'm going to talk about the tension between income and estate and gift tax. And then I'm going to talk about a few different issues that relate to basis step up. So example, you have an asset that's worth $1 million that has a $300,000 basis. It's growing at 10% per year. So every year it goes, if you would say in the first year, I'm not going to do every year, the first year, the $1 million value would increase by 10%. So after 1 year, it's going to be worth $1.1 million. We're going to get into that number in a moment. I just want to say it while we're here. The donees combined federal and state capital gain rate is 25%, and there's a 40% estate and gift tax. So, by the way, somebody was asking about the CPA Academy webinar. If you go into my website, it is November 11th. They found something else that's had a different date, but November 11th is my first podcast of it. Okay. Suppose the donor dies 1 year later, there's a $1.1 million value to the property. So there's a $100,000 increase in it. So there was a $40,000 estate tax saving when you take a 40% rate and apply it to the $100,000. If you take the $1.1 million value minus the $300,000 basis, that's $800,000 lost basis. And if they were to sell the property right away afterwards, then there'd be capital gain tax of $200,000 because they have the $800,000 lost basis times 25%. So that $200,000 capital gain tax is more than a $40,000 estate tax saving. So in this case, we would want to consider doing a preferred partnership where the senior family member keeps the original value and gets a preferred return on it, which is basically going to be the rent. and then they'll get a full basis step up on the original value. And then the growth might go to the kids. And while the kids won't get a basis step up at death, they will get a what was I going to say? So they won't get the full basis step up in death, but they will get a full exclusion on that from the estate tax. So they are having there's still a trade-off of lack of basis step up versus estate tax savings. The estate tax savings is more immediate, but at least it's only the estate tax on the growth. I'm sorry, the income tax on the growth. So if you went back to this example, we have the second bullet point. If it's $100,000 of appreciation, and you had a 25% capital gain rate, they have an increased capital gain tax of $25,000, but they have a $40,000 estate tax saving. So they have lost, they have saved more in estate tax than is cost of a capital gain tax. So the preferred partnership may be worth it instead of doing this outright gift idea, the entire thing. Now, let's talk about getting a free basis step up. So in a common law state, husband creates a trust for wife with discretionary distributions to wife and in the husband's sole and absolute discretion. On wife's death, the trust passes to wife's estate. If the husband terminated the trust before the wife's death, the trust goes outright to wife. So the sole and absolute discretion by husband is going to cause estate inclusion. The probate estate by wife is going to cause estate inclusion. So, and I'm going to mention on this next slide. So the trust qualifies for marital deduction because it cannot pass to anyone other than the wife. The gift is completed because the beneficiary is known with certainty. And the trust is includable in the husband's estate under 2038 and a wife's estate as a probate asset. All assets should be held in a member-managed LLC, so it's managed without probate delays. So the idea is that you'll have a robust series of successor managers. So when there's a death, immediately the next manager can take over, next one up. It's like we say in sports. And the disadvantage is that you cannot make the reverse Q-tip election if the husband dies first. And I mentioned about Q-tip planning generally in my first quarter 2025 webinar. And just kind of as a side note, we did have a 2025 case relating to a marital estate trust, but that was a testamentary marital estate trust. So it's really not all that relevant to our discussion, but if you're doing one, you might want to just take a look at that and see. But I do have an excerpt from that in my materials. All right, so today's third secret word is treat. So please select the correct word below. So treat is the secret word. Okay, while you're answering the poll, I'm going to start talking about community property, and then I'll go to the slide after I've had enough people respond to the poll. So suppose we have a community property trust. Each spouse owns 1/2, but all assets receive a new basis under Code Section 1014B6. And now I can go on. We've had 75%. Each spouse puts 1/2 of the assets. Each spouse, considered to own 1/2 of the assets. But the question is, do you get to say that we have the community property being a whole, or do you say that each spouse had 1/2 of each property? Now, the Propster case was before the unlimited marital deduction. And the Ninth Circuit held that you look at each spouse's 1/2 interest in the real estate, and there was a 15% discount on each spouse's 1/2, so they did not get a full basis step up. Now, that is not the desired result now, because we have an unlimited marital deduction, so we want to get a free basis step up. So whenever somebody's a community property state, they ought to check to make sure that they have whatever community property agreements are needed, or they have the appropriate community property law that will avoid that 15% discount. So I'm thinking about putting that in my next webinar to talk about joint trust and community property trust, et cetera. So we'll see whether I intended that, whether I'm going to do that. I said in my newsletter I would, but we'll have to see. In a common law state, if you want to do community property state instead of the marital estate trust, then we have you could go ahead and put it in a community property state, put the joint trust in the community property state. Perhaps do a directed trust, so the trustee is just doing administrative functions, and the trustee can reduce their fee appropriately. And then if you have real estate, in order to apply the community property law to the real estate, if the real estate is in a common law state, and you want to apply community property law to it, then you need to put the real estate in an LLC, and then the LLC will be considered to be personal property, and then you can apply the community property rules to that. And so the advantage of this over the marital estate trust is that when the first spouse dies, you can apply the reverse Q-tip planning. Somebody asked if there are Powell concerns if we put the assets in the LLC in that marital estate trust, and the answer is no, I'm not concerned, because we want 100% estate inclusion anyway. So, and you already have a completed gift. So I'm not concerned with that. If you have a community property LLC, you're not really doing it for discount planning. You're doing it for you're doing it more to just try to get the community property law to apply. So I think you have a better ground on that than Powell. And I generally would not be overly concerned about it. Okay. Plus the fact you have an unlimited marital deduction the way I have it, so it's probably not going to be a big deal anyway. All right, let's talk about the 1-year rule. Code section 1014E applies that you don't get a basis step up if appreciated property was acquired by the descendant by gift within a 1-year period, and the property passes back to the decedent. So if husband is going to die first and wife gives all her assets to husband within 1 year of death, and then wife gets back all the assets afterwards, then we would not get the basis step up. Again, if that's only if husband dies within a year. But I do have a solution that we're going to get to in a moment. Now, if and to the extent the donor receives only a partial interest on the relevant death, then 1014E disqualifies only the partial interest. So let's say, for example, wife gave this property to husband, and then husband left it to wife in a Q-tip trust. And let's say the Q-tip trust had mandatory income to wife, but wife had no other interest in the trust. So in that case, you would say, well, what's the actuarial value of the mandatory income interest? And that portion does not get the basis step up because wife is getting the mandatory income interest back. But the principal, the actual value of that does get a basis step up. So that portion of the property will get the basis step up. Now, what are some planning tools? So first of all, you would want to avoid the decedent having any beneficial interest to die within 1 year. So maybe husband's estate plan will say, if I die within 1 year, then I'm going to take the credit shelter amount and give my most appreciated property to the kids, trust for the kids. Now, as to the first bullet point, when you have this partial interest disqualified, how do you value it? So I have some materials that go in on how you value beneficial interests. Those basically generally work off of the credit for tax on prior transfers under Code Section 213. But you'll see I have a whole section on it. Okay. What if you have a sale from the surviving spouse? Again, we have, instead of wife giving the property to husband in my example, wife sells depreciated property to husband. Does that count as a transfer by gift, or does that count as a sale? Well, we don't know under 1014E1. We do know that Code Section 1041 says that if wife sells to husband, that's a transfer by gift for purposes of avoiding a capital gain on that sale. So I do have a concern about it. But what if husband created an inter vivos Q-tip for wife? So even though wife is the beneficiary, husband is the deemed owner of that under Code Section 677, and you can also apply the spousal attributions under 672E, but you don't really necessarily need to. So in that case, the wife sells to this inter vivos Q-tip trust that's deemed owned by the husband. So in that case, I feel very confident that you would get a full basis step up on that. And I'm going to go through that in a moment. But before I do that, I'm just going to also note another benefit to this inter vivos Q-tip. Wait a minute, I think I got that backwards. That last bullet point would be if wife created inter vivos Q-tip for husband, and then that what got included in husband's estate for estate tax purposes, because of 2044, and then wife sells the property to the trust for husband. Okay, I'm glad I had that reminder there. So it was wife creating the inter vivos Q-tip trust for husband. Wife sells the property to the inter vivos Q-tip trust. That trust, after husband dies, that remains a grantor trust because wife was the original grantor and husband did not exercise the general power of appointment over it. All right, so what happens when you do the sale here? If Code Section 1014E1A looks to transfers for income tax purposes, then it's the disregarded transfer rather than a transfer by gift. If it looks to transfer by state law for state law purposes, then we had a sale under state law. So either way, this transaction would work. Okay. When the donor creates an irrevocable trust and the beneficiary is granted a general power of appointment if the grantor does not allocate GST exemption trust. So we're calling it a contingent general power of appointment. So you have a trust for the lifetime of a beneficiary, and and it says if, while the beneficiary's death, if the grantor allocate GST exemption, then the beneficiary does not have a general power. They might have a limited, but they don't have a general. But if the beneficiary, if there was no GST exemption allocated and it were to pass to that beneficiary's children, then there would be a general power of appointment. So if the donor allocates GST exemption to that trust, then that takes away the general power. So is the donor's ability to terminate that general power by allocating GST exemption a prohibited retained interest? Because after all, the donor, after creating the irrevocable trust, has the right to take away that general power. Furthermore, suppose you make a gift in 2025, when does the donor allocate GST exemption to that? That is allocated on a gift tax return filed in 2026. So you've got a lag there. Now, if that does cause estate inclusion, then you have what's called an estate tax inclusion period. And then you can't allocate GST exemption retroactively to the date of gift in 2025. You would have to take a look at the value of the gift at the time the GST exemption is allocated, not the value of the gift, the value of the trust at the time the GST exemption is allocated, and allocated based on that value. So that would be complicated. Now, we had a letter ruling in 2008 where there was a contingent general power appointment, and the transfer of assets through a trust merger into that general power appointment did not create estate tax inclusion issues for the donor. So that kind of said, well, we don't have to worry about this ETIP issue. But we have a few rulings in 2025, and those expressly express no opinion on whether the donor's opinion to terminate the general power caused ETIP issues. Now, several prominent GST experts are upset by the IRS's apparent change in position. And some argue that the mere ability to make the tax election should not generate gift or estate tax consequences to the person with that ability, because just a tax election is just inherently different. You know, the tax laws apply. You don't have any control over whether you get that power to make the election, so we're not going to count that. Now, one of the prominent GST expert who's very vocal about disagreeing with the IRS's position says, well, look, we don't want our clients to be a test case. Don't do the contingent general power appointment. So even though she thinks it's okay to have it in there as a matter of technical law, you don't want to have a fight with the IRS on it. So she says, just don't do that. So what's the solution? Do not include a contingent general power. Instead, you might authorize a trust protector to add a general power. And most decanting statutes expressly authorize adding the general power, whether the distribution standard is merely health, education, maintenance, and support, or is absolute discretion. Now, I have to tell you that I really disagree with the theory of those decanting statutes if you merely have a HEM standard. Decanting applies to the principle that could have been distributed. So if you're going to add a general power to the trust, then it really could be added only with respect to the principle that could have been distributed. So the theory of decanting doesn't really hold true if you have an ascertainable standard, unless that ascertainable standard is large enough that it would let you terminate the trust. Nevertheless, the statutes say that if you have the HEM standard, you still can add a general power. They don't put any limit whatsoever on it. So that's another nice benefit. So if the trust, if you don't have it, if you have a lifetime trust, there's no contingent general, and you want to add a general. So in other words, you have a pretty well-defined situation. The grantor has said, they don't think they're ever going to allocate GST exemption to this trust, or maybe you split the trust up, and there's some that the donor has ample GST exemption to cover. The rest they just don't. There's no way they're going to ever have enough GST exemption to fully exempt that trust. So what you would do is then you might want to add the general power to that trust that is never going to get GST exemption allocated to it. If you want to have a trust and kind of you kind of gotten to a certain point where you know how much is going to have GST exemption allocated and how much won't, then split the trust, add the general power, like I said, the best practice might be to authorize a trust protector to add the general power. But even if you don't have that provision in your trust agreement, then you likely are going to be able to do a decanting to add that general power. Now, I have created a formula that provides for a basis step up, but not a basis step down. And I addressed this formula in a few different. It's in my big PDF. You see at the top, there's a reference to 2H2K. But if you'd like to get a verbal explanation, I have some webinars. You can see these 3 bullet points to talk about basis step up. Those are one of my 3 segments of that. So you can go in and see my discussion about those and what the IRS has approved in formula powers of appointment. And the IRS's private letter rulings approve way more than they should. I would not rely on IRS's private letter rulings in this area. Okay, final note. Does the death of the grantor of an irrevocable grantor trust generate a basis step up? So some people have talked about this very loudly over the years. And they say, yes, there is a basis step up. So Congress got concerned about this, and they had, they said, IRS, we want you to issue something about it. So the IRS issued a revenue ruling that says the answer is no. Now, some of the proponents of this basis step up will say, well, the fact situation and the revenue ruling can be distinguished. So, you can look for yourself whether you believe that or not, and whether you want to take a tax return filing position that's contrary to that position. And in fact, a taxpayer did do that. And that resulted in the case Belmont Investors LLC versus Commissioner. And they have October 3rd, they have a petition that asserts the basis step up. They have since filed their briefs in the case, or at least the petitioner has. Top estate planning tax litigators are representing the petitioner. So we will have an answer at some point to this question. The taxpayer did do a good job of noticing it up, so they should avoid penalties. I do know somebody who claimed that about, I don't know how long ago, it was maybe 10 years or so, but I'm totally off on my time frame. But they said they once showed a $1 billion basis step up, and they did the 8275, and the IRS never audited them. But apparently, now that they have the revenue ruling out, they may be going after this. Okay, so that concludes it. Here's some resources you can get, and there's a link to my CPA Academy instructor page, as I said, for those who want to get the October 11th version of this. Thank you for participating in the webinar. I really look forward to having future contact with you. And please complete and submit the survey that we'll display at the end of the session.